Hey traders, Raghi here, and in this update we're going to talk about VALE, an individual stock. And while I'm going through this setup, I want you to think about a few things. One, where is VALE an outperformer within what sector? Two, the options opportunity that we had. And three, the underlying stock opportunity that also presented itself. So lots of ways to look at this. Let's kick it off with the bigger picture. VALE is the number one weighted stock within the SLX ETF. Now, why does that matter? SLX is the steel ETF, and it has been on a very good uptrend for most of the year. Mid-June, we saw the reflation trade absolutely turned upside down as the Federal Reserve changed the trajectory of expected increase in rates. All right, so the reflation trade absolutely tumbled. SLX tumbled too, but interestingly enough, VALE was able to maintain its uptrend. That should get your attention because it's a relative outperformer. The criteria for the relative outperformance is very simple. We use the exponential moving averages. Maybe you've heard me refer to something as double green before. Well, double green's a whole lot easier to say than the 8, 13, 21, and 34 exponential moving averages are structured in a way that suggests the path of least resistance is to the upside. We're playing probabilities, right? Those EMAs will paint these two rows at the bottom of the chart, and just by looking at the colors that are printing, we know what the probability is for movement up, down, sideways. So clearly, the green tells us the market is most likely to move higher. All right, so now we know why we're interested in VALE, relative outperformer and really good, sound, bullish structure. So what did we do? Right here on this pullback, and this occurred on, so just so you can follow along the timing, June 17, so the day after the Federal Reserve, June 17 created the pullback. And at that level, we were able to scoop up the VALE stock at about $21.05. Now think about it. If you want to buy a stock, this is a really good price point in terms of the entry, and it's an affordable stock. It's an affordable option as well. This option cost $1.85, which is $185 per option for the 20 call for September 17. So we're talking about well over 90 days, almost 100 days to expiration for $185. Now think about $185 for a moment. How many of those could you buy in your account comfortably? For most traders who have larger accounts, and this is a very liquid name, you could buy many of these $185 options. But if you're working with a smaller account, this is still very affordable. The idea of scalability is what runs through all my trading. Can you take the same approach, the same stock, the same option, and for some people they might buy 2, another person might buy 22, but it's the same setup. So as you get better at this, you of course can grow into larger and larger position size with the same strategy. So as the market continued higher, up into this area, which was, by the way, resistance before, resistance, we traded right up into that area, and into that high, we took profit at $2.90 or $290. So we bought it for $185, we sold it for $290 per option, and that's a $105 return on a $185 option. All right, scalability. Now, ultimately, there's probably another chance that we might be able to do it again. So we love the opportunity of these patterns and the repeatability and the scalability of playing something like VALE, a relative outperformer, very affordable stock if you want to play the underlying with the same timing and the options that you can play along with this trade.